Welcome back to the Stocks Updates. When a stock drops by over 50%, it can feel like a golden opportunity to buy low and sell high. But with great potential comes great risk. Supermicrocomputer NASDAQ, SMCI has seen its stock price plummet by 57% in just 6 months. Is this a chance for savvy investors to jump in, or are there deeper issues at play? Let's break it down. Investing in stocks that have experienced significant price drops can seem like a golden opportunity for those seeking high returns. However, such investments come with a substantial level of risk. Stocks that face sharp declines often do so for underlying reasons, and the possibility of further losses is always present. Supermicrocomputer NASDAQ, SMCI is a prime example of such a stock, showcasing both promise and potential pitfalls. Over the past 6 months, its stock has fallen by 57%. Prompting many to question whether this is a rare buying opportunity or a warning sign. At first glance, Supermicro's reduced stock price may appear enticing, but a closer look reveals that its future heavily relies on its financial stability and the outcome of a recent audit. The company has been granted an extension by the NASDAQ exchange to submit its annual report for the fiscal year ending June 30, 2024, and its first quarter report for the period ending September 30, 2024. The findings from these filings will be instrumental in determining whether investor confidence is restored or further shaken. The root of the issue traces back to October when Ernst Young EY, Supermicro's previous auditor, resigned. This wasn't a mere formality. EY's resignation raised concerns about the company's internal controls and the independence of its board, which was seen as being too closely tied to CEO Charles Liang. EY even expressed its unwillingness to endorse the company's financial statements due to these issues, adding to the uncertainty surrounding the business. Though disagreements between companies and their auditors are not unheard of, the nature of this split was particularly concerning. It raised serious questions about Supermicro's governance and financial integrity. If the new auditor, BDO, clears the company's financials without significant revisions, it could restore investor confidence and potentially trigger a rebound in the stock price. However, if significant adjustments are needed, the appeal of Supermicro's stock as a bargain could quickly fade. Currently, Supermicro's stock is trading at roughly 15 times its earnings, a ratio that might seem appealing for a company in the growing server and IT infrastructure sector. With the rising demand fueled by advancements in artificial intelligence (AI), the stock's low price-to-earnings P ratio may appear to present a great buying opportunity, even amid some uncertainties. However, this valuation could quickly lose its appeal if the company's financials are adjusted. Early estimates for the first quarter 2025 earnings and second quarter guidance could be drastically affected if major corrections are needed. Such adjustments would likely inflate the P multiple, making the stock look far more expensive than it currently does. The lack of clarity surrounding Supermicro's financial health presents a significant challenge for investors. Until the company files its audited reports and the situation becomes clearer, determining a fair valuation for the stock is nearly impossible. This uncertainty underscores the risks associated with investing in Supermicro at this point in time. Given the uncertainty surrounding the company, the most prudent strategy for most investors is to adopt a cautious, wait-and-see approach. While the steep decline in stock price and its low valuation might entice bargain hunters, these factors are only relevant if the company's financial statements can be trusted. As of now, that is far from guaranteed. For investors with a higher risk tolerance, purchasing Supermicro shares could be a speculative move with the potential for substantial rewards. However, for those who prefer a more cautious strategy, it might be wiser to look elsewhere for growth stocks that don't carry the same degree of uncertainty. Supermicro's immediate future depends on a few key factors. First, the company's ability to file accurate and timely financial reports will be crucial. If BDO signs off on the financials without major concerns, it could signal the beginning of a recovery for the stock. Moreover, improvements in governance and internal controls would likely be reassuring to investors. However, if significant adjustments to the financial statements are needed, it could further damage investor confidence and result in additional losses. This would overshadow any potential benefits the company might gain from its position in the rapidly expanding AI and IT infrastructure sectors. Supermicrocomputer stock offers an intriguing yet risky opportunity. Its substantial price drop and appealing valuation could indicate potential for growth, but the unresolved issues with its financial reporting and auditor concerns introduce a level of uncertainty that investors cannot afford to ignore. For now, patience may be the wisest course of action. Waiting for the audited financial statements and updates on the company's governance will help paint a clearer picture of its true value. Until then, investors should proceed with caution, carefully evaluating their risk tolerance before committing. Supermicro's journey serves as a reminder of the importance of thorough research when investing in stocks that have undergone significant price drops. The rewards can be substantial, but the risks are equally high. In Supermicro's case, the coming weeks could be decisive in determining whether it's a hidden gem or a stock best avoided. If you found this video helpful, please give it a thumbs up and consider subscribing to the channel. Your support helps us continue to bring you in-depth market analysis. Thanks for watching, and I'll see you in the next video. Take care.